This is WealthBT, a podcast of BT correspondents.
Have you heard the phrase capital guaranteed on death to describe investment-linked policies or ILPs? I first heard it last year, and frankly, I was appalled at the lengths some advisors would go to clinch a sale. It seems this pitch is not uncommon. It's clearly a way to reel in customers by appealing to Singaporeans' preference for low-risk and guaranteed investments. But it becomes especially risky when it's used in the context of getting you to compromise your potential CPF Life payouts in favor of ILPs. Welcome to WealthBT, part of the BT Correspondents family of podcasts. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. With me today is Christopher Tan, Chief Executive of Providend, a financial advisory firm. Welcome, Chris. Thank you for joining us.
Hi, Jen. Thanks for having me back.
Chris, in your Money Wisdom column in the Business Times in May, you wrote that someone asked your advice on whether she should invest in an ILP rather than put more money into her CPF retirement account. So what happened there, and what does this choice involve?
Yeah, I think to be clear, this is actually a common friend of my Deputy CEO, Evelyn, and she actually approached Evelyn to show her a proposal from a FA rep from another FA company. And this particular lady, our friend, she's, I think, turning 55 years old, not very investment savvy, and not an affluent individual. And because I know her, I know that most of her retirement funds are actually with the CPF. She doesn't have very much other than what she has in her CPF accounts. What the FA rep proposed to her is that instead of setting aside the full retirement sum, which is currently about $220,400 into her RA, this FA rep proposed to her that why don't you use your property to pledge? So you only set aside the basic retirement sum, which is just about $110,200 into your RA. And then you take the $110,200 extra and you go and buy an ILP. That's what was proposed to this friend of ours. And in the sales material that was given to her, which we saw, it seems like the FA rep has used the historical returns of two underlying funds, and the return is between 8.19% and 12.34%. And so the rep actually used the historical returns to project two outcomes. So the first one is at 65 years old. If she wants to, she can withdraw about $221,000. So after buying this ILP for 10 years, she can choose to withdraw $221,000. Or alternatively, she can choose to have $1,200 thereabout per month, what the rep called dividends for life. And the sales material also compared the two options that she has, which is firstly, set aside FRS at 55, and then at 65, you get about 1,640 per month. No bequest from age 80. That was on the sales material.
Right.
And the second option is set aside BRS plus buy the ILP and get $2,161 per month from age 65 and pass on a estimated $200,000 bequest upon her demise. And in addition, on the sales material, it was shown that there is a capital guarantee upon death. And then finally, the sales material ended with the BRS plus the ILP option as the recommended option because she's going to get a higher payout and leave a legacy. So that was actually what we saw on that sales material.
So based on the feedback you got, and maybe your observations as well, how common actually is this kind of pitch?
I mean, honestly, before I wrote this piece, on and off, I've heard of it. Even in the article that I wrote for the column in May, I was actually approached by an insurance agent. One morning, I was having breakfast and this agent came and he was pitching the same approach. But after I wrote the piece and then I shared it on my social media, a lot of people started commenting. And in fact, my own colleague also told me that actually it's quite prevalent. The target audience, most of the time, they are seniors. In fact, there was one person who commented on my LinkedIn page that he was approached by a FA rep who actually pretended to be a CPF officer. It was only much later that he realized that, oh, actually, this guy is not from CPF board. He's actually an FA rep. So I think it is quite prevalent. And sadly, most of the quote-unquote victim they are actually the senior people and maybe not as financially savvy.
You write quite often about CPF Life, and so do I. But actually, in the market today, there are insurance products that offer like an annuity income, whether they are whole life, par plans, or really an annuity with a level of guarantee. So how do these plans differ from the CPF Life?
Yeah, so factually speaking, if you compare CPF Life with all these plans from the private insurers, in terms of payout per dollar premium paid, no one actually is better than CPF Life. In terms of payout per dollar premium, CPF Life is indeed the best annuity, the best retirement income product in Singapore. CPF board allows you, if you can find another retirement income product that is better than CPF Life, you can actually apply to CPF board to be exempted from participating in CPF Life and buy the private annuity instead. This is actually allowed, right? But the fact is that there isn't. Rather, there aren't any products out there that is better than CPF Life. But having said that, I think there is still a place for retirement income products. For example, when someone, after setting aside enhanced retirement sum, today it's about $440,800, 10 years later, the payout would be about, say, $3,300, $3,400. And after even they do that, that amount is not sufficient for them to meet their retirement expenses. And if they want more, and if they are financially able to, they can go and buy a retirement income plan if they want certainty. So that's one situation whereby RI plans can still be useful. Another one is for someone who may not want to put everything into the retirement account because they don't want to be overly reliant on CPF Life. Because if you just depend on one product, one instrument such as CPF Life to fund your retirement lifestyle, then you are taking on concentration risk. You are taking on the full risk of the policy or policy risk. And also with CPF Life, we know that while it's good, there is a lack of flexibility. You cannot terminate it, right? You cannot so-called surrender CPF Life. With a private annuity, you can. If you are prepared to take some hit, you're prepared to lose some money, you can surrender. And why is surrendering even something to consider? It could be that in retirement, because of certain illnesses, you have a shortened lifespan. Then you're not going to enjoy the payouts from CPF Life. And so you may want to take out your money now and maybe go for a trip. With CPF Life, you have no option. But with a private annuity, you have the flexibility. There are some circumstances whereby some of these RI plans are still suitable, despite the fact that they are not better in terms of payout per dollar premium as compared to CPF Life.
Because the original case that you brought up, this lady was kind of asked to just put up the basic retirement sum. And she had a balance that could have fulfilled the next level. Under what circumstances would it make sense for someone to just have the basic retirement sum rather than higher amounts?
You know, the policy thinking BRS is this. How we size the amount for basic retirement sum is we look at a person in a household, a single person in a household that belongs to the second quintile group in terms of monthly expenditure. We look at what this person needs, and therefore when he reached 65 years old, the CPF Life payout must pay him this amount that he needs. So that's how BRS is sized. So if he has BRS at 65 years old, this single person in the household will have enough to pay for his expenses. And it's fine if he has a house. But if he doesn't have a property, no shelter over his head, then he needs another portion of the BRS, so in total FRS, so that he will have a monthly payout that will pay for the rental of a room. So that's how we size BRS and how we size FRS. So that's the policy thinking. If a person has other sources, and I'm talking not about a person that belongs to the second quintile, it can be you, it can be me, somebody who financially more able. If they have other sources of income coming in from similar instrument like a private annuity, or they buy a bond and the coupon pays out a regular income, and it is enough to meet the retirement expenses, then okay, you can set aside BRS. You don't really need the FRS. So that's one situation that I would say that, well, BRS is still okay. The other thing is that, there are people whom they want some flexibility, right? And so maybe they will put into BRS, but the other amount they want to buy a private annuity just to have that flexibility. Now, although we don't really encourage that, we really encourage that at least in your RA, you should have full retirement sum. But I think the point of the article that I wrote is not about whether setting aside BRS and then buying an investment instrument is wrong. I think what is wrong really is the sales process, right? Because there's a lot of misrepresentation, there's some malpractice there. You are giving your potential client the impression that that option, BRS plus a ILP or BRS plus, for that matter, any investment instrument is as safe as a CPF Life. I think that's the problem.
Still to come, a sales pitch for an investment product usually shows you potentially great returns and a high yield, but you're not told the full picture. What's the best way to guard against such mis-selling?
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region, with analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to WealthBT, a podcast of BT correspondents.
Welcome back. The MAS and the LIA have taken a stern stance against the use of the phrase capital guaranteed upon death for ILPs. So, Chris, what's so wrong with using that phrase?
If we use it in the right context, I mean, capital guaranteed upon death is not wrong technically because there is some guaranteed component upon death. If you are buying the so-called in the industry called a 101 ILP, in the event of your demise, you will get 101% of the premium that you put in, regardless of the value of your investment. So yes, there is some guarantee over there, but when we say capital guarantee upon death, there are some risks. And really, that is why this term capital guarantee upon death, you don't find it in the ILP policy. ILA said the same thing, right? It's not a term that should be used. Why? Because firstly, I think this term capital guarantee carries strong cognitive baggage. When people hear the word capital guarantee, they may miss out upon death, especially in a conversation. So in their mind, they are thinking this is capital guarantee. Yeah. And the worry is that even when they are alive, they think there is a capital guarantee. And the second risk is capital may not be fully guaranteed in situations whereby you have done withdrawals. You may have done withdrawals and then you forgot about it and you don't remember that whatever withdrawals you have taken out, when you die, it's no longer capital guarantee because you're going to minus off the withdrawals. So that's the second thing. And the third thing is that because an ILP is still an insurance instrument, the 1-year suicide clause still applies. So people think capital guarantee upon death, they don't hear the word upon death, right? That's one problem. And secondly, it's still subject to insurance regulations, right? So you may not really get that guarantee. And because of the risk, I think LIA rightly pointed out that advisors should not use this term when they are selling ILPs.
When it comes to mis-selling, and you earlier alluded to this, you make the distinction between product and the process. So can you share your thoughts here?
Jen, you know our stand on ILP. We don't find it to be a useful product for investment management. ILP is an investment package instrument. It is a package product, and because it is a package product, it comes with layers of fees. When MAS implement the new regime, classifying ILP as a complex product, the new product highlight sheet will have to show this layer of fees, right? And there can be up to 8 layers of fees. And it's because it is a package product, like a structured product. And also, when it becomes a structured package product, it makes investment management very inefficient because it's very rigid. So that's our stand as a product where ILP is concerned. But I think the issue that I have raised in the Money Wisdom column on the Business Time is not about products, but really about process. Because even if the FA rep used a low-cost index fund or an ETF instead of an ILP for illustration in his sales material, it would still be wrong because in the sales material that I've seen, there were a lot of misrepresentation and malpractice. Using historical returns to project the income stream and capital appreciation is wrong. Secondly, comparing a market-based product like an ILP with a government-backed insurance annuity is not apple-to-apple comparison, is also wrong. And in this case, the sales material also gave an impression that the bequest is certain. So it's not really just a product problem, but the process is really, I think, in question, right? So that's, I think, the point I was trying to raise in the article. But I just want to end by saying this. The more unnecessarily complex a product is, the higher the fees you have to pay as a consumer, the higher the compensation to the distributors, the higher the compensation, the higher chance of malpractice, because compensation does drive behavior. And I think for the retail clients, and especially the seniors, I think this is not good because they cannot understand the complexity of the product. They may not see the fees.
So what do you think is the best way to guard against mis-selling? Because the industry has been through this for decades and it still happens.
Yeah. I had a conversation at MES just about a week ago and they asked me, what can we do to stop this malpractice? I think it's very difficult, honestly, because we can put in place a lot of regulations to govern the sale of the product, which we have, but there are always ways to circumvent the regulations, right? And by the time someone is caught, sometimes it's too late. The client, the consumer would have already lost money. I mean, to me, the best way to protect yourself is financial education. I started talking about term insurance since 2004. When I first wrote about term insurance, I still remember the article that I wrote on the Business Time column. It's called Confession of a Financial Advisor. The industry was very upset that I spoke about using term as the product of choice because it's the most affordable and it's suitable for most situations. But it's been 20 years. And over the last 20 years, we have seen the change. Consumers are a lot more aware of why term is actually more useful. And today, because of that demand, because consumers are more educated, the advisors in a way have no choice but to prescribe term insurance. Now I'm hearing more and more advisors talking about term insurance instead of using whole life. So I think that's the way. Unfortunately, it's a long process. Unfortunately, sometimes in this case, the consumers have to tell the industry what to do. So I think that's the best protection for yourself. Don't depend just on regulations because it can be circumvented.
Thank you, Chris, for sharing your insights.
Thanks for having me.
The CPF Life is a very good annuity scheme that pays an income for life. Since it's managed by the CPF, there are no fees, no commissions, and no volatility. That's why you have to be extra careful when someone tries to persuade you to put less funds into your retirement account because it means less funds for CPF Life. My Mind the Gap column raises this question. Should you give up some CPF Life income in favor of ILPs? I hope you look it up in the Business Times. That's it for WealthBT this week. BT Correspondents will be back with an episode on transport. This episode was produced by Howie Lim and Chai Pei Chie, together with our editor Clarissa Montero, and was written and presented by me. I'm Genevieve Cua. Thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.